Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering some of the key provisions in the draft tax legislation that was released on May 12th. We're covering this in greater detail at Spiedel's post-tax season update and review webinar, and there are still slots available for the remaining sessions at spiedel.com under webinars. Late in the evening on Friday, May 9th, the House Ways and Means Committee released a partial draft of the tax legislation we've all been waiting for. Then on Monday, May 12th, they released the complete 389-page draft bill. We'll cover some of the most important tax changes in the draft bill, but there are many more provisions that we'll continue to cover as the bill makes its way through the legislative process. The bill permanently increases the state and local tax itemized deduction limitation to $30,000 or $15,000 for married taxpayers filing separately. The deduction would be phased down for taxpayers whose AGI is over $400,000 for married taxpayers filing jointly and $200,000 for all other taxpayers. However, the deduction would never be lower than $10,000 or $5,000 for married taxpayers filing separately. The bill increases the IRC Section 199A deduction from 20% of qualified business income to 23%, and also expands the deduction to include certain investment income. The additional investment income would be treated the same as REIT dividends within the 199A calculation. The bill also makes the 199A deduction permanent. The bill temporarily increases the child tax credit to $2,500 per child for tax years 2025 through 2028, then drops the credit back to $2,000 thereafter. However, the $2,000 credit would be adjusted for inflation starting in 2029. This would be a permanent provision. The bill would terminate all three clean vehicle credits. The previously owned clean vehicle credit and the commercial clean vehicle credit would terminate after December 31st, 2025, and the clean vehicle credit would terminate after December 31st, 2026. Additionally, the bill would terminate both the residential clean energy credit and the energy efficient home improvement credit after December 31st, 2025. These are credits for residential solar, home batteries, and other property, and energy efficient windows, doors, and other property, respectively. The bill would permanently increase the uniform estate and gift exclusion to $15 million per taxpayer with annual inflation adjustments starting in 2026. The bill retroactively extends 100% bonus depreciation for qualifying property acquired after January 19, 2025 through December 31, 2029. The bill reinstates immediate expensing of domestic research and experimental expenditures for tax years 2025 through 2029. Research conducted outside the United States would still be subject to the 15-year amortization rules currently in place. The bill does not allow for immediate expensing of domestic research expenditures made before January 1, 2025 that are subject to the amortization rules currently in effect. The bill permanently extends the TCJA's higher standard deduction, but it includes a couple other temporary increases. For tax years 2025 through 2028, the standard deduction would be increased by $2,000 for married taxpayers filing jointly, $1,500 for head of household, and $1,000 for single filers. The bill would also increase the additional standard deduction by $4,000 for taxpayers who are age 65 or blind. The additional $4,000 standard deduction would be phased out for taxpayers whose AGI is over $75,000 or $150,000 for joint filers. Sign up for Spiedel's quarterly federal tax update webinar and you'll get reliable and pertinent updates on trending tax topics. Get details on this subscription webinar series and register for a full year of updates or just a single session at spiedel.com under webinars. That's all for this week. Join us next time for another episode of Spiedel's Federal Tax Minute.